Extreme policies indicate that the establishment is desperate. Well, hello, Martin North, John Adams, in the interest of the people. Hello, John, good to see you.
Hello, so how are you going today?
Pretty good. Been a busy old time, hasn't it?
It has been a very interesting few days. Big shock on Saturday night with the election. And then since then, we've had APRA and the Reserve Bank come out straight out of the gate yesterday, Tuesday, basically announcing a series of extreme policies, in my view, on the 7% rule around what percent do banks have to assess people on, and then with the flagging interest rate cuts. And we got told right throughout the election we have a strong economy and that we need to re-elect the coalition government to continue the strong economy, and yet we have a whole host of policy measures that would suggest that we don't particularly have a strong economy.
Yeah. And in fact, of course, we've been saying for some time that there were some important leading indicators of issues in the economy. And in fact, more and more economists over the last 3 or 4 months were saying the same. And yet the Reserve Bank seemed to be right there at the bullish end of the spectrum. But they are changing their tune a bit now, aren't they?
Exactly. So particularly in the first quarter of 2019, we had a whole series of indicators saying that the economy was, the bubble was starting to fall apart, from falling credit growth to building approvals to falling property prices, defaults on greenfield sites, falling discretionary in terms of consumption around cars, etc. And then obviously we started to see a bit of an uptick on unemployment, particularly New South Wales, Victoria, but also in the construction sector and a couple other sectors as well. So we saw a lot of weakness, and obviously, it was always a myth in my view that the economy was strong, and to be honest, I was somewhat surprised with the election result. And one of the main reasons was because I was on the phone with politicians on a consistent basis within the government, and they all expected to lose. And so I had several politicians who said that we hope we can narrow the loss, but we don't think we're going to come back. And yet, obviously, it was a big shock to a lot of people that the election result came out the way it did. So now, having said that, I spoke to several MPs since the election. And I did, being polite, congratulated them on their re-election. But I did make the point that just because you won doesn't mean that the debt has gone away. The crisis, the Armageddon, is still coming. And rather than being able to blame it on the ALP, you guys have now to you have to now handle this crisis moving forward. And some of these people indicated that they were hoping to have high-level discussions with the Prime Minister and the Treasurer about these issues. But what we've seen in the last few days has effectively trumped any possibility of backbenchers reasoning with the Prime Minister.
Well, indeed. So effectively, we are back on to try and re-energise consumer spending through more debt.
Yes.
Through the household sector.
Precisely.
That's the recipe.
Exactly. So there's a couple of points to make. I've been on the phone in the last 2 days. I've been talking to property developers, to real estate agents, to mortgage brokers, and it is true to say that there is a flurry of activities. I spoke to a mortgage broker in North Sydney. He said in Monday and Tuesday he got 10 inquiries for new mortgages. Real estate agents are saying that in Sydney, properties between 550,000 and 800,000 are going off the shelf. Property developers who were sitting on the sidelines in Melbourne, they're all ready to jump back in. Now, a lot of this is because everyone was nervous about the shortened policy package, particularly around taxes. But also around maybe industrial relations and the energy policies. So I think we're seeing a sign of relief by people in the property sector, people tied with the bubble. We're seeing a whole bunch of flurry of activity coming in. Now, speaking to an advisor to a senator last night, they were surprised that APRA and the Reserve Bank has moved so quickly on these initiatives, because they thought that maybe they would want to hold off the ammunition and just see that whether the relief of short of not coming into power would be enough to stabilise the market. But the fact that APRA and the Reserve Bank, now, just didn't wake up on Monday morning and say, we're going to do this. This would have been long planned out. And obviously they didn't want to do it during the campaign to politicise or to inject themselves into the political debate. But the fact that they've jumped in with these extreme measures indicates that the relief by certain segments of the market that Shorten's not Prime Minister, that's not enough to stabilise the market, and they think they need to inject new stimulus in so that they can try to get credit growth back up and to get this market going again.
Sure, and of course the Council of Financial Regulators, which includes the Treasury, it includes APRA, it includes RBA and ASIC, they're all sitting around the table talking about this stuff. So it's not like they're doing this thing in an uncoordinated fashion, right? They're all thinking about it around that table and then basically executing their components. That's the way I see it anyway.
Yeah. Yeah. So I mean, when we talk about extreme policy, so we've talked about a couple of them, but I think there's a whole gambit of what I would call extreme policies that we probably heard in the last fortnight that's worth just covering at a high level. So obviously, we've started to see a bit of a walk back. We saw it during the campaign, a walk back from some of the key recommendations from the Royal Commission,
yep,
particularly around mortgage brokers, trailing commissions. So the mortgage brokers put up a big stink. And obviously, what the Royal Commission found was 50% of the mortgages were written by mortgage brokers. So obviously that segment of the market is quite important, particularly in terms of getting people into debt. So, Hayne wanted to clamp those down. Now, I don't think that was necessarily a big, an overly big deal, because I thought that if people wanted to get into debt, they would just go straight to the banks. But the mortgage brokers had enough influence on Frydenberg to wind back some of those recommendations. We saw the 5% first home deposit scheme announced by Morrison during the Liberal Party launch. A lot of people are scratching their head as to, is this sound policy? Now, in a falling market, it makes no sense, because even if you buy with 5% deposit, you could be in negative equity within 2 or 3 months. Now, the Prime Minister promised that property prices and home equity will increase under his government. Now, he didn't indicate how this will happen, but that is the promise, that property prices and home equity will go up under this government. So if everyone should write this down in their diaries and go back to the launch speech. He said home equity will go up under this government. So this is a key, what I would call a key campaign promise that we can judge the Prime Minister on. So, but again. Now here's the thing. They said this is about affordability. If you are concerned that young Australians can't get into the market, the best thing to do is let the market drop, because as property prices fall, they need to get into less debt, and you have a lower deposit and they can get in. So you don't need to basically have a 5% deposit. Just let the market let the market rip, as what Kevin Rudd said 10 years ago, and first home buyers can get a great bargain. But why do they do this? Remember, this was the Property Council, where Scott Morrison used to work in a previous capacity, went to the Prime Minister, said, we want you to announce this. The day after the announcement, Frydenberg was on the AM program on the ABC. Sabra Lane asked Frydenberg, where's your modelling? Did you take this to Treasury? He didn't answer the question, so effectively no modelling, no scrutiny, I suspect no cabinet discussion, and this is all about trying to get more people into debt to put a floor under the market to stabilise prices. So that I think is a reckless policy, and I was quite surprised that 2 hours after the announcement, Labor basically said, well, we're going to do the same. But that's what they announced before the election. Now that policy. So the 730 Report did a story about it yesterday. A number of young Australians are very excited about this policy, and I don't think they fully realise that this is a technique to actually get them caught in the debt bubble. But I think from memory, the government announced, because I was reading it last night, that the government announced that this measure will come in on 1 January 2020.
Yep.
So there's that. You've got the personal income tax cuts that were announced in the budget, and they'll either come in before 1 July or just after 1 July, depending on when Parliament sits. And obviously, this is about giving households greater levels of disposable income so that they can meet debt repayment obligations as well as cost of living. Now,
Up to $1,000. I mean, it's such a big amount.
Yes. Now, one of the key things is that the Reserve Bank governor gave a speech yesterday, and one of the key assumptions, which I just think is complete fantasy, is that the growth in disposable income is operating at about 2.75%, and the assumption is that it's just going to magically get up to 4%. Now, the Reserve Bank, from what I could tell, maybe you've got a different view, they don't explain how disposable income is going to the growth is going to get to 4%, but maybe these tax cuts but could play a role. I mean, I'm not sure exactly what the Reserve Bank thinking is, but they've got this graph 5. Anyone could look at the RBA governor's speech, and he's just got this magical line that goes from here all the way up, and I just don't think that's going to happen. But the tax cuts could help with income growth, and that potentially could, either reduce cost of living pressures or provide some impetus for people to get into the market.
My theory is that interest rates will be down quite significantly, and that will reduce mortgage repayments, and therefore that will give more disposable income. That would be my theory.
Yes. Well, we will get to that. So now it's interesting. Michael Yander from the ABC, he said he's been an economics finance reporter for 11 years. He has never seen a more clearer speech by the Reserve Bank indicating that they are going to cut. So the next RBA board meeting is on the 4th of June. So we will expect to see at least a quarter point cut and maybe a cut in the second half of the year. So I think the indication so far is the cash rate will be pushed to 1%. Now that comes with a series of consequences. A lower dollar, so the dollar should go down. We're at about 68 cents today. So it's interesting that some analysts this afternoon said that they expect the Aussie dollar to outperform other currencies in the second half of the year. But if they continue to cut rates, and our rates are substantially lower than the Americans and some of the other counterparts, why would people invest with us when they can make more return in overseas markets? That picture's not stacking up. But I think there's some risks around the dollar. There's some risks around how much of these cuts can the banks pass on, given that they have a huge exposure to short-term foreign debt. That picture will play out as to how effective that will be, given the foreign debt position.
But just one thing there, John. It's worth saying that Australia just started to import wheat for the first time for a long time, right? Which means essentially that's another example of if the exchange rate goes lower, we're going to be importing higher costs of goods.
Yes.
And it's to do with the drought and all of those things. So I think we're much more exposed to the interest rate moves, and the exchange rate moves in particular. If the exchange rate does actually drop, we're going to import inflation big time.
Exactly. And so the last change was in terms of the APRA announcement. So we sort of mentioned it before, but starting in about December 2014, the APRA announced that mortgages needed to be assessed at around 7%. On a principal and interest basis, and that buffer has been in operation for then. Now, I think it's fair to say that the use of or the following that buffer, some banks were playing fast and loose with that before the Royal Commission. There is a view that some banks are more strict about the application of that 7% rule since then. But this was a campaign pushed during the election campaign by the Australian Financial Review. Christopher Joy, he was leading the charge around reducing the 7% rule. And true to form, the APRA has announced a 4-week consultation period to basically say we're going to go away from the 7% and we're going to have a 2.5% buffer. And now we don't know what that buffer is likely to be applied on, but it's likely, as you and I discussed off camera, the effective rate. So if the effective rate is around 3.94%, add about 2.5% on that, you get to about 6.5%. And you're going to increase that plus the interest rate cuts. You're going to give the marginal borrower some additional capacity to borrow, and that is the name of the game. So this is what I said in the debate against Christopher Joy. It's all about credit growth on an annualized basis at 4%. It is at a record low. If they can't stabilise or get credit growth back up, this bubble will pop. And so they need the growth of debt to keep going because it is a debt Ponzi scheme. And the other thing that there hasn't been a big discussion of is if you're going to keep a Ponzi scheme going, I expect we're going to have a generous number of net migration immigrants coming into the country for the rest of 2019 and 2020. So, backbenchers on the phone are saying to me, we hope that things are different. I mean, one MP said to me that the coalition is a more responsible political party to manage the bubble compared to Labor. But all we have seen so far in the early days of the government is a continuation of the bubble, the throwing of the kitchen sink in the bubble. There is no acknowledgement from the Prime Minister that we have a problem or that we have to do anything different. We just say there's this narrative, we have a strong economy, yet we're launching all of these extreme economic policies and they don't explain why they're doing it. But it is the fantasy. They're continuing the fantasy. And one of the things I did say to these MPs, I said to them, well, and one of these MPs has served in Parliament for 25 years. He's like one of the elder statesmen of the Liberal Party. And I sort of said to him, even though, just to be clear, I'm not a member of the Liberal Party anymore, but I said to this MP, I said, well, you guys have to be, you've got to be careful about how you manage this crisis, because look at what President Hoover did in the Great Depression. He mismanaged the crash of the stock market in 1929, and that basically had electoral consequences for a generation. Republicans took 20 or 30 years for them to regain trust with the American people. So I said to this Liberal MP, I said, well, if the coalition screw this up, a generation of Australians won't forgive the Liberal Party. So I said to him, you as being on the backbench, you've got to keep your Prime Minister in line. So
good luck with that.
Well, look, indeed, and I think this is an important point to make on camera, is to say that there were MPs who tried to speak to the Prime Minister and the Treasurer before the election about some of these issues. They didn't want to hear it. They didn't want to acknowledge that there's problems. They didn't take these concerns seriously, because all the banks and the market economists and Treasury and the Reserve Bank saying there was no problem. So any dissenting voices from the backbench were just basically cast away. Well, both the Prime Minister and the Treasurer have massive egos, and what I said to these backbenchers is they just won the unwinnable election. Their egos are going to be sky high. They're not, if they weren't going to listen before the election, they are definitely not going to listen after the election. So it is a dangerous position to have a political leader who won't acknowledge there's a problem, and is not willing to listen to dissenting views. And this is the situation that Australia finds itself in, and I think politically it's a very dangerous position for the Australian middle for the middle class.
So I suppose that means that if we think about the rest of this year and into next year, there are some other issues to think about, right, as well, in terms of what might impact the property market. I mean, there may well be a little bit of a rush back, right? We might see some stuff later in the year, in the spring selling season and things like that. But there are also a few other things in the background that may actually also help to dampen demand.
Yes. So a couple of points to make here. So I spoke to some analysts who work for some of the investment banks today, and I think that the view that I've come to, and some of the analysts I spoke to, is that. So we're going to see GDP come out in 2 weeks. It's going to be a weak number because it is a historical number. Yep. So we're not going to know whether the change in sentiment because Shorten didn't get elected, plus these new extreme policies, we're not going to know the effectiveness of them until about September, October. So once we get into the spring season, we'll have to look at lending. We'll have to look at property sales. Not just the auction clearance rates, but the number of auctions being cleared and settled. Are we seeing a bounce back in retail sales, etc. So, but also in terms of building approvals, new construction. So it's pretty much whatever you see and hear in the media from now until September. In terms of the domestic economy, largely put it to one side, and then once we get into the spring, we will have a clear view as to whether these moves have actually had any impact. Noting that one of the big things that are coming over, or two things coming over the horizon, is one is the judge decision in the ASIC Westpac case on responsible lending. I mean, that is a huge decision, and I think you've said that you think that the government will lose the case, and if the government does lose the case, and that the use of the HEM was deemed to be legal by Westpac and the other banks. I think perhaps ASIC will take some further action to ensure that pre-Royal Commission behaviour doesn't continue. So that case and the aftermath of that case is a critical factor to consider, but also comprehensive credit reporting. So some of the banks are using it. So basically, and you're a better person to explain this, but at the moment, if you go to a bank and you've got other debts or other business with other banks, it's been hard for the banks to cross-check your full financial position. But with comprehensive credit reporting, which is supposed to be, correct me if I'm wrong, they're hoping for 100% take-up by mid-year.
Yeah, so some of the banks are using it now for applications, others aren't. Some of the smaller banks are yet to really come fully on board, so it'll a little bit longer. But already now there is a better view of a total financial footprint of a household, which means that in fact the assessment of the risks of a particular proposition is now easier than it was, and it will get ever more powerful as the data is collected ahead.
Yeah. So just to explain to the viewer, comprehensive credit reporting is the ability of the bank to look at, so if I went to the bank and I had multiple loans or multiple products from several providers, the bank will be able to see my full exposure, and I won't be able to necessarily lie and say, well, I don't have something with the Commonwealth Bank, whereas they could say, no, you actually do, sort of thing. So there'll be more visibility around that. So these are some key things, but it's really September will be sort of, where we can really know whether the domestic bubble, independent of the rest of the world, whether it will stabilise or grow, or whether it's going to collapse. So that's what to say on that. But in terms of, from here until then, there are some big headwinds internationally. I mean, the RBA governor did talk about trade. So we are seeing an intensification of the US-China trade dispute. And we are seeing the value and volume of global trade falling. So that's having a drag on the domestic economy, on the global economy. So you have that. You've got Brexit. You've got rising tensions between the Americans and the Iranians, and that could have a big impact around the oil market. Like in the last 24 hours, Deutsche Bank hit an all-time low for the share price, and their derivatives book is so big that it could trigger a global financial crisis. And I think it's reasonable to say that the German government is propping Deutsche Bank up, but if that support were to withdraw, and there was a declaration of insolvency with Deutsche Bank, that could have a huge meltdown in the global financial system given their derivative position. So you've got that. You've got the Italian debt position, the fiscal management there. You're seeing an ongoing breakdown of the petrodollar system. So there is some emerging evidence. I got an email this afternoon around some data that it looks like the Saudis have been selling crude oil to the Chinese in yuan out of the US dollar. So you're starting to see some big movements in the international monetary system in the oil market there. And you're starting to see huge hoarding of gold by non-Western countries. So there's a range of things happening outside of Australia that could have huge implications for the financial system, the monetary system, and that could have big disruptions with us. So perhaps now remember when Treasury went to speak to, they had these secret meetings, a few months ago in Europe. This was all on the assumption that we would have a global shock. So perhaps our focus should now shift for the next few months back to the global shock position and see if something overseas is going to blow up. But we'll know around September whether we can revisit the proposition that we put forward earlier this year about Australia going first.
So John, one question I have, there are a bunch of policy positions that potentially might get traction or might not get traction in this parliament. What are your thoughts on that?
Sure. So, before the election, there was a whole host of issues to do with the debt bubble, to do with the banking system that I was talking about, that you were talking about, but also other organisations like the Citizens Electoral Council. So whether it was about Glass-Steagall, whether it was about in terms of bank separation, ending horizontal vertical integration, in terms of bail-in. So basically there are some big systemic issues with the banking system that the Royal Commission, basically let through to the keeper. There was, I was sort of hopeful that with either a dramatic change in the composition of the Parliament or even a change of government, we could have had, an opportunity for some of these issues to be considered by Parliament and for these issues to be resolved. But the fact that, I think the coalition maybe lost like 1 or 2 seats. And yes, there were some MPs that are retired. There are some new MPs that are new to the Parliament, both in the Senate and the House of Reps. But largely, the key players are still the same. And so I suspect that on bail-in, we will get no clear guidance from Parliament. They'll still say that it's impossible to happen in this country. On Glass-Steagall, that nothing will happen there. On bank separation, nothing will happen there. And obviously, bank separation. Why that's important with Glass-Steagall is we have 4 too big to fail banks, and that creates moral hazard. And the banks can take massive risks, knowing that the government won't let them go because the risk to the economy and the society is too great. And so, one of the big fears that I have, to be honest, is that, and some people don't believe this, but I really do think there's a risk that the banking system and the regulators will go back to pre-Royal Commission behaviour. We started this, there was an article in the Australian Financial Review today that criticised APRA for their gross level of secrecy around some of these reports, self-assessment reports that the banks did, and the AFR, which is traditionally the propaganda arm of the banks, criticised APRA for exhibiting pre-Royal Commission behaviour. So, I don't think we've seen dramatic changes in APRA's approach or the approach of ASIC. Obviously, the Reserve Bank really hasn't changed, and so so there is a risk that if we take an eye off the banks, some of these irresponsible lending practices could potentially seep back in. One of the things I actually didn't fully realise with the Royal Commission was we had a Royal Commission in the 30s, and we had a Royal Commission in 2018, and so it was about about 80 years between Royal Commissions for the banks. So it's actually no mean feat to get a Royal Commission into the banks. And now that they've seen this off, maybe the banks will have a level of confidence that, well, we're not going to have another detailed investigation into the banks. We have a Prime Minister and a Treasurer that basically are very friendly to the sector, and there is a risk that I think that in order to kick the can down the road, we may get aggressive lending moving forward. But on a whole host of these issues around the structure of banking and some of these intricate details around bail-in and others, I don't see any prospect of genuine reform or discussion in the new Parliament.
No, I tend to agree too. I think it's back to same old land. And I'm already seeing early signs of backpedaling here and being a bit more secretive over there and opening the lending taps a bit more. So I suspect that all that effort and all the issues that were exposed in the Royal Commission will be in the rearview mirror very soon, and we'll be almost back to where we were before we started.
Yep.
And I suspect that there will be a number of people within the political infrastructure in Australia who will be hoping for an international crisis to bubble up and emerge, so that they can then say, well, it wasn't us, it was them.
Exactly. And so I've said this on camera, I'm willing to say it again. I did have a meeting with a government MP last year. They did say that elements of the establishment realise that they've made some big policy mistakes, and they have a strategy of plausible deniability. They are hoping for the global shock so that they can say it wasn't us, it was overseas. So, for example, if Deutsche Bank went down tonight, the government and the Reserve Bank said, well, we don't control that bank, we don't control the Germans, it was their fault, not our fault, and we just have to deal with the ramifications. But and to be honest, to some extent that is true, but the reality is that we are in the most vulnerable position for a global crisis in our history. and we are. The Australian middle class is unprepared. I think our policymakers are unprepared. The media won't talk about these risks, and we're going to sail into a crisis, whether it starts domestically or whether it comes from overseas. But the message for me is, if anyone thinks that just because Shorten's not Prime Minister, Armageddon's not coming, well, no, the crisis is still coming in my view.
The clock is still ticking.
The clock is still ticking, yes, sir.
John, thank you very much for your time.
Thank you.
Martin North, John Adams, in the interest of the people. We'll see you next time.